Money makes more money? That's certainly true. And it's even more valid when you work with other people's money, which is what we'll be referring to as leverage in this lesson. Many firms are happy to take on board external financing. There are several reasons for that. First of all, when external financing is involved, you are not only using your money, but you are also using other people's money, which allows you to scale operations significantly. For some projects, external financing could be as much as 4 or 5 times the equity invested in the project. Most investors are eager to participate in larger projects because these larger projects offer a higher potential reward, and a number of economies of scale and scope can be realized. That's certainly one of the main advantages of using external financing. If things go well, they go really well. And if things go wrong, well, we used mostly external financing. And because less equity is invested from investors, and rewards are potentially high, given that this is a large project, this can turn out to be very lucrative for equity holders. Imagine a project that earns $3 million per year, and $15 million of equity has been invested. Now think of the same project earning the same amount, but the main difference is that only $5 million were invested, and that $1 million per year is paid for interest expenses. The remaining $10 million were financed with debt. There is a significant difference in the return for shareholders, right? In the first case, when we used only equity, the return would be 20% per year. While in the second case, when less equity was invested and we paid interests, the overall return would be 40%. So, we can conclude that a highly levered business will be more profitable if things go well. And that's an important reason why aggressive shareholders prefer highly levered deals. The downside of debt is that we have to pay interest expenses, right? But we also shouldn't forget that in most jurisdictions, interest expenses are tax deductible and, hence, can be recognized as a non-taxable cost in the P&L of a company. That's another important advantage and a reason why profitable businesses prefer debt financing. It isn't all rosy, of course. There are certain limits that have to be respected. If too much risk is taken on board, a company would become too risky. Banks and bondholders will likely ask for a much more expensive cost of debt at some point if they deem the financial structure of the enterprise too risky, and that there isn't sufficient equity capital and collateral to cover the money they have provided. For some types of business, such as real estate, companies borrow significant amounts of money because creditors feel much calmer when they know the money is invested in real estate, and real estate values tend to be stable over time. In other businesses, such as technology, creditors are much less inclined to offer a low cost of debt and significant amounts of money, and we often see these companies with zero or very little debt on their balance sheet, being entirely financed with equity. And when firms like Google, Facebook, and Intel become really successful, they don't need external financing anymore, so technology companies rarely use it. The main insight from this lesson is that, yes, in some cases, leverage could potentially increase shareholders' returns, but that happens when the company is reasonably levered and its creditors do not feel too exposed and do not look for ways to raise the company's cost of debt. Okay, great. In our next lesson, we'll offer you a numerical illustration of what we just saw. Thanks for watching. The reason why a company can't continue to increase its leverage indefinitely is that the more debt it has on its balance sheet, the riskier it is perceived by creditors. The way lenders see it, there are two things guaranteeing the repayment of their loan: the borrower company's operating cash flows, its profitability, and its assets. However, there is a catch. If a firm goes bankrupt, the first guarantee goes out the window. What about the second one? Most of us know that assets tend to be sold at a much lower price when a default occurs, and some of them cannot even be sold. In this case, equity owners are the first ones to sustain losses. Their investment is a cushion that protects debt holders. If the value of the company's assets is sufficient to repay debt holders, then they won't sustain any losses. Equity holders will be the ones sustaining losses. However, if the value of the assets sold is really low and the entire equity of the company is wiped out, lenders will be the next ones to sustain losses. And here, we can agree that the more debt a company has and the lower its equity is, the higher the chances of debt holders losing significant amounts when a default occurs. In other words, banks' credit risk is that much higher when a company is highly levered. So, how does this impact the cost of debt according to you? When banks expect to sustain losses themselves, they will raise the cost of debt in order to compensate such losses. Hence, all else being equal, cost of debt is higher when we use higher leverage. The best and most practical way to see how this happens in practice is to observe the cost of debt of comparable companies. Firms of a similar size, operating in the same industry, should have a cost of debt corresponding to their leverage. This is a great exercise, actually. You can try to see how cost of debt changes for companies that have a financial debt to liabilities and equity ratio of 40, 45, and 50%, for example. The company that has a higher leverage should pay a higher cost of debt, right? If you carry out this exercise for more firms, you will be able to reconstruct the cost of debt curve for a given industry, which is a great exercise that provides valuable insights. By the way, do you know how to measure a company's cost of debt? It is given by its interest expense, reported in the P&L, divided by the value of all interest-bearing liabilities. Alternatively, if you don't have these numbers and a company has issued bonds, you can check out the yield of its 5 or 10-year bonds. That should be a good approximation. Okay, this is how we can get an idea of how a company's cost of debt changes when it increases its leverage. This will do for now. Thanks for watching.